Silver just crashed 8% in 48 hours, from $90 to $76. And every finance channel right now is asking the same question. Is this the buying dip of the year or the beginning of something much worse? But here is what none of them are telling you. While retail investors were watching silver's price fall, one of the most powerful banks on Wall Street quietly walked into the room and changed their entire silver forecast. Not by a little, by a catastrophic amount. And if you understand what they changed and why they changed it and what they got wrong the last time they made a call like this, the next 60 days in silver becomes significantly clearer than anything a price chart can show you. This is the most important institutional signal in the silver market right now, and it is hiding in plain sight. Let's start with the facts. Silver hit $90 earlier this week, then dropped more than 8% in a single session on Friday, closing near $76 an ounce. That is a $14 move in 48 hours. For context, that is not a normal correction. That is a violent institution-driven repricing event. Three forces caused it simultaneously. First, April CPI data came in at 3.8% year over year, hotter than the 3.7% forecast, the highest reading since May 2023. That single number wiped out every remaining expectation of a Federal Reserve rate cut in 2026. Traders are now pricing in a rate high probability by December. Second, the US dollar strengthened sharply on the back of that inflation data. A stronger dollar mechanically pressures all metals priced in dollars. When the dollar moves, silver feels it faster and harder than gold because silver's market is smaller and more reactive. Third, and this is the one that retail investors completely missed. UBS, one of the world's most closely watched commodity banks, released a note that directly attacked the silver bull thesis. Not softened it, attacked it. Here is what UBS actually said. They slashed their full-year silver investment demand forecast from over 400 million ounces down to 300 million ounces. That is a cut of more than 100 million ounces in a single revision. But that was not the most aggressive part of their note. UBS also projected that the global silver market deficit, the gap between how much silver the world consumes and how much it mines, would shrink dramatically. Their previous estimate for the 2026 deficit was roughly 300 million ounces. Their new estimate is 60 to 70 million ounces. They cut their deficit forecast by more than 75%. Now, if you follow silver at all, you know how significant that is. The multi-year supply deficit has been one of the single most powerful structural arguments for silver's long-term bull case. The idea that the world is consuming more silver than it produces and has been doing so for 6 consecutive years has been the bedrock of the institutional case for higher silver prices. UBS just challenged that bedrock directly, and that is what accelerated the sell-off on Friday. When a major institutional bank publishes a note like that, algorithms and hedge fund risk managers react immediately, not because they necessarily agree with every assumption in the note, but because institutional risk management doesn't wait to debate. It moves first and debates later. So the retail investor watching silver fall on Friday saw the price chart. The institutional trader had already read the UBS note 3 hours before the market opened. That information gap is what costs retail investors in every single cycle. Now, before you take that UBS note as the final word on silver, I want to show you something important. Because institutional banks publish research notes, and those notes are not always right. In early 2025, when silver was trading between $28 and $32, multiple major banks, including UBS, had consensus forecasts for silver averaging somewhere between $28 and $35 for the full year. Silver ended 2025 with an average price of $40.03, and on January 29, 2026, silver hit an all-time high of $121.67 per ounce. Banks with $35 full-year forecasts were more than 200% below the actual price at that moment. Now, I'm not saying UBS's current note is wrong. I'm saying that institutional research notes reflect the information and assumptions available at the moment they are written. And the silver market has a history of moving faster and further than any institutional model expects, in both directions. So the intelligent response to the UBS note is not panic, and it is not dismissal either. It is to understand exactly which assumptions they changed and whether those assumptions are actually correct. UBS cut their deficit forecast primarily for 2 reasons. One, they project silver investment demand to fall because of rising real yields and reduced rate cut expectations. That argument is valid in the short term, When rates stay high and rate cuts disappear, investment demand for non-yielding assets like silver does face pressure. 2. They cited softer industrial demand, specifically solar silver demand. And here is where the detail matters. Solar silver demand fell 6% in 2025 and is forecast to fall another 19% in 2026. That sounds alarming for the silver bull thesis. But here is the nuance that institutional notes sometimes flatten. Solar installations are not falling. Solar capacity additions globally are actually accelerating. What is changing is the amount of silver used per solar panel. Manufacturers are improving panel efficiency, getting the same or better output from less silver per cell. So you can have more solar panels being installed globally and less silver demand from solar simultaneously. That is not bearish for silver's long-term industrial thesis. It is a short-term efficiency headwind on one specific demand category. The AI infrastructure build-out still requires silver. EV manufacturing still requires silver. Defense electronics still requires silver. And none of those demand categories are being revised downward by UBS's note. There is one more factor driving silver's pressure today that has nothing to do with UBS. Iran. Reports emerged over the weekend suggesting a possible breakthrough in US-Iran negotiations, with the US reportedly considering lifting sanctions on Iranian oil and Tehran potentially agreeing to a long-term freeze of its nuclear program. If that deal materializes, oil prices fall, energy inflation eases, the Fed's rate hike pressure reduces, and some of the geopolitical safe haven premium in gold and silver deflates. That is bearish for precious metals in the short term. But here is what investors need to think about carefully. We have been here before in this conflict. Breakthrough reports, optimism, metal sell-off, then negotiations collapse, then metals recover. The Strait of Hormuz has been partially or fully disrupted for months. The structural economic damage from sustained oil above $100 does not disappear overnight, even if a deal is signed. And even a genuine Iran deal does not resolve the Federal Reserve's inflation trap. Oil is one input into inflation. Housing, energy infrastructure, supply chain costs, those don't normalize because of one diplomatic agreement. So trade the Iran news carefully. Watch whether a deal is actually signed, not just reported. Because in this market, the difference between a report of a deal and an actual deal has been worth $5 to $8 on silver within a 24-hour window. Let me give you the 3 scenarios for silver from here, based on what the data actually shows, not what either the bulls or bears want it to show. Scenario 1. The bear case materializes. UBS's deficit revision proves correct. Iran deal is signed. The Fed signals a rate hike. Dollar stays strong. Silver tests the $70 to $72 support zone. Not a collapse, but a painful continuation of this correction. Scenario 2. The base case holds. Iran talks stall again. CPI data for May comes in slightly softer. The Fed holds but avoids hiking language. Dollar stabilizes. Silver finds a floor between $74 and $78, consolidates, and the structural deficit story gradually reasserts itself. Silver recovers towards $82 to $86 over 60 days. Scenario 3. The bull case surprises to the upside. The UBS deficit revision proves too aggressive. Physical demand stabilizes faster than expected. Industrial demand from AI and EV sectors accelerates beyond current forecasts. Dollar weakens on any softening of Fed language. Silver squeezes back above $85 fast, catching short sellers offsides. In a small market like silver, that kind of short squeeze can be extremely violent. Which scenario is most likely? Honestly, in this environment, scenario 2 is the most probable near-term path. Consolidation, not collapse. Recovery, not explosion. But the silver market has a history of skipping scenario 2 entirely and going directly to scenario 3 faster than any institutional model predicts. Watch the $73 to $74 level. That is the critical support floor right now. If that level holds with volume on the buy side, the consolidation thesis is intact. If it breaks, scenario 1 becomes more probable. Here is what separates professional investors from retail investors in a moment like this. Retail investors are watching the price and asking, should I buy or sell right now? Professional investors are reading the Commitments of Traders report, the COT data, which shows actual positioning by institutional and commercial traders in the silver futures market. At elevated silver prices near $85 to $90, commercial traders, who are typically the most informed market participants, were positioned net short. That positioning contributed to Friday's sell-off when the CPI trigger arrived. The question for the next 30 days is whether institutional buyers begin rebuilding long positions at these lower levels, around $74 to $78. If COT data over the next 2 weeks shows commercial short covering and managed money accumulation at current prices, that is the institutional signal that the correction is bottoming. If COT data shows continued short building, the correction has further to run. Most retail investors don't track COT data, which is exactly why institutional traders have a persistent edge in this market. Let me end with the view from 30,000 feet. Silver hit an all-time high of $121.67 in January. It is now at $76. That is a 37% correction from peak to current price. For most assets, a 37% correction would signal a bear market. For silver in this specific environment, it represents something different. The COT positioning signal I just described, most YouTube finance channels won't mention it this week. That information gap is exactly what this channel exists to close. If that matters to you, subscribe right now, because the next video I am releasing covers the one specific signal in the Federal Reserve's internal framework that could trigger a complete reversal of everything that just happened to silver. Not a rumor, not a prediction. A specific documented mechanism that has preceded every major precious metals recovery in the last 40 years. That video is coming very soon. Subscribe and hit the notification bell, because the investors who see that signal early will have a meaningful advantage over everyone waiting to react after it has already moved the price. And drop your answer in the comments right now. At $76, is silver a gift or a warning? One sentence, your best analysis. I read every comment. The most insightful one gets featured in the next video. See you there. Silver went from roughly $30 in January 2025 to $121 in January 2026. A 300% move in 12 months. No asset moves 300% without significant corrections along the way. The question is not whether $76 silver is cheap or expensive in absolute terms. The question is whether the structural forces that drove silver from $30 to $121 have fundamentally changed. The 6-year supply deficit, even if UBS is right that it narrows, still exists. The world is still consuming more silver than it mines. The electrification of the global economy still requires vastly more silver over the next decade than current mine supply can provide. The monetary debasement thesis has not resolved. Global debt levels are still expanding. Central banks are still buying gold at historic rates. UBS changed their short-term demand forecasts. They did not change the decade-long structural reality of the silver market. That distinction is what separates investors who react to weekly price moves from investors who build positions based on structural realities. The weekly price tells you what the market is doing right now. The structural reality tells you where the market is going eventually. Both matter. The best investors hold both simultaneously. Here is the honest truth about this channel. I built it to give you the kind of analysis that used to require a Bloomberg terminal, a Wall Street research desk, and a subscription most people can't afford. Not just the price, not just the headlines, the institutional signals, the mechanism behind the move, the data beneath the data. The UBS note that crashed silver on Friday, most retail investors had never heard of it before this video.